Hello, everyone. Today on the Final Bar, I'm catching up with Kathy Donnelly. We'll look at some recent IPOs with some particular charts that might be of interest to you. We'll also talk about the distribution happening in the markets. Happy Distribution Day here on Tuesday, April 5th, as we have the market rolling over. The Nasdaq down over 2.3%, the S&P down 1.3% as well. The growth trade coming off after having a strong update to the upside. Which is right, yesterday's upswing or today's downdraft? Ladies and gentlemen, this is the Final Bar. Everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using data visualization techniques, the technical analysis toolkit to better understand what's happening in the world around us. I probably misspoke in the brief introduction a little bit ago. I said, which one's right? The up day yesterday, the down day today? The answer is, to be honest with you, they're both right. There's no right or wrong with how the market moves day to day. And you have to remember that even if the overall trend is positive or negative, you're going to have up days and down days. I often have told people that one day does not make a trend, right? A trend is made up of a series of days all lining up together, all combining to make these larger patterns. And people like Bob Prechter and Gann and other analysts, Elliott, who founder of Elliott Wave or creator of Elliott Wave, talk about this fractal nature of the markets. The more and more fine-tooth you go into and look at daily data on stock trading, you'll find some of the patterns that you'll see in some of the in the larger time frames as well. So technical analysis really is time frame agnostic. It's all about understanding the time frame you're looking at and looking at the right charts to fit with your point of view. We have great guests on the show. I'm excited to talk to Kathy Donnelly here, joining us on the show again in a short while. Tomorrow on Wednesday the 6th, we have Mike Zaccardi, who's one of the authors on our Top Advisors Corner here on StockCharts.com. On Thursday the 7th, we have Bob Lang from Explosive Options, expert in options trading, equity derivatives, giving us some ideas there. Also, just so you know, all next week, I am out on vacation. I am super excited to take the family down to Mount Hood in Oregon and get away from all the craziness for a week or so. We are actually going to be doing a week of special programming called 5 Hidden Features of Stock Charts. Every day, I'll share with you a feature of the platform that I think people are underappreciating and underutilizing, what it is, how it can fit into your toolkit. So make sure you check out our shows all next week as we share with you some good ideas from the power users of our Stock Charts platform. Let's continue on today's show with our market recap. Let's break down some of the activity in the markets and focus on what the charts can tell us about how that fits into the overall market conditions. You can see the tale of two markets, with yesterday the S&P accelerating to the upside, and right out of the open that actually continued. First 30 minutes was fairly strong, and then we reverted pretty quickly down to the downside. After around 10 a.m. Eastern, the market continued to push lower and lower highs and lower lows. The S&P finished down about 1.25% to 45.25. The Nasdaq composite is just about 14,200, down 2.25%. Mid caps and small caps both down as well, and outpacing the S&P, with the small cap S&P 600 index down 2.25%. I was mentioning earlier in the we do a teaser on social media every afternoon, and I mentioned there are only two things that were up earlier in the day: the VIX, volatility, and the dollar index were sort of the two. Utilities I'll throw in there because it had a nice run there in the afternoon, and overall showing some strength relative to other sectors. So not a great look for this market if you're bullish, with some very defensive stuff like utilities, really healthcare, REITs, consumer staples. These are the sectors that were flat to positive. The real growthy stuff that led yesterday, also energy actually down on the day in a pretty big way. Interest rates actually pushed higher. So bond markets were lower, so technically right, interest rates were higher, with the 10-year yield pushing above 250, actually ending the day around 255. Bond prices obviously lower. The dollar index, as I mentioned, is higher. We usually use the UUP as a proxy for the dollar index. It was up about 0.5% from Monday's close. Looking at commodity markets, the DBC down 0.8%, gold and silver both down as well, and silver leading the way down just over 1%. Oil prices down pretty good, and that's why the energy sector was struggling. Some of the other commodity ETFs that we track were positive, but broadly speaking, weak day for commodities. Out of our top 10 cryptocurrencies that we track on our platform, 9 out of the 10 were down today, with Bitcoin and Ethereum both giving up some of the recent gains. Ethereum now back below 3,500, even though it spent some time above earlier in the session, and Bitcoin down just over 1%, sitting right around that 46,000 level. Let's look at a chart of the S&P 500, just talk about the conditions and how they've changed and what today's trading means relative to the longer trend. So, as we talk about the charts of any kind on the show, I tend to talk about the markets in 3 different time frames. For me, the long term is sort of a retirement account, kind of years down the road. Medium term is a couple months to a year. And that's really the sweet spot for a lot of the technical toolkit that we talk about on the show. The short-term time frame for me is a couple days to a couple weeks, and then there's a very short-term time frame, which we really don't get into a ton on this show, more of the day trading, swing trading type of time frame. But I would argue that if that's the time frame that you live on, if that's where you're trading, you better be familiar with what I call the short-term and medium-term time frames, because there's a lot of capital being rotated around those sort of horizons and those goals. And those are the flows that are going to impact. They're going to create the movements that you see on your charts minute to minute, second to second. So understanding that longer-term bias can be really, really helpful, even if you're a short-term trader. If you look at what happened to the chart of the S&P here, we bottomed out just below 4,200, had a couple attempts to get below there, but never really followed through any close below 4,200. From there, we've bounced very, very well, and the last couple of weeks have really been driven by the growth-oriented parts of the market. Some of the parts of the market, to be honest, that struggled in the first 10 weeks of the year, all of a sudden led in the last couple of weeks. Now we're potentially resetting there. This week has been more of a choppy sort of consolidation week where it's not super clear just based on this week's trading what's happening. You have a day like yesterday, growth leading to the upside. It feels like the S&P and the Nasdaq are going to go make new highs any day now. Then today happens and it feels like back to risk off. It feels like investors are getting defensive. It feels like you're taking bets off the table. So what's right? I think in general, you take a step back and you look at the overall trend in the market. I think it's worth noting on sort of that medium-term time frame that I talk about, the S&P attempted to get above 4,600, closed above there one day, and really didn't follow through. I think that was last week. That was probably Tuesday or so when we closed above 4,600 for the first time since the beginning of the year. We didn't follow through, right? We had one day closing above there on that gap, and then all of a sudden you rotate back lower. From there, that's been the high water mark. You really haven't regained 4,600. So I would argue if you're bullish here and you're looking for some validation that the uptrend is in play, there's maybe a brief pullback, but the uptrend resumes and we're going to get to 4,800 plus in the next couple weeks. You need to get above 4,600. We need to follow through. And by the way, we talk about follow through a lot on the show. That's the concept that you have one day of breaking a pattern, breaking a resistance level or a support level, breaking above a trend line. That doesn't make a valid breakout. To really be validated, in my opinion, you need follow through. You need some sort of further confirmation that new trend is in play. And that's why when we broke above this trend line resistance here a couple weeks ago, the comment I probably made, I don't remember exactly, but I'm guessing what I said was, interesting that we broke the trend line. We need some confirmation, which we very much got the next day, right? We had further follow through, indicating that wasn't just all the momentum pushing the prices above 4,400, that there was more potential upside in that area. So from there, we've now stalled out at 4,600. If you're bullish, I would want to see a close above 4,600 that's validated. If you're bearish, you want to see us get back below the 200-day moving average and see this as a brief move above the 200-day, similar to what we saw there maybe in February, early February, before we rotate and make the next leg downward for the S&P. Looking elsewhere, just talking about sector movements a little bit, it's worth noting that it was a defensive feel to today. Again, yesterday was sort of like the 3 growthy sectors, then everything else. Tech, consumer discretionary, communication services, all up 2% or more, if I remember right. And then everything else was flat to down, with some of the defensive stuff down pretty good. Today, you sort of flip that entire thing upside down. The things that led yesterday, were right back down. The Nasdaq, which had a nice run yesterday, undercut yesterday's low. So you gave back all of yesterday's gain and a little bit more. You see the same on the 2-day chart of the Dow, the 2-day chart of the S&P, where we had such a distribution today. It took us below the open from yesterday. So that shows you how much of a rotation lower. I'm guessing I might get asked about bearish engulfing patterns, and you really didn't get that on these. So if we look at the SPYs, for example, and we bring up the candle, I have a chart that just zooms into the candles a little bit. Here we go. It's really not a bearish engulfing pattern. Bearish engulfing pattern is where you have an up day and then a down day, and day two actually engulfs the open to close range of day one. So it's literally, day two engulfs the first day's range. That's called a bearish engulfing pattern. You really didn't get that today because the open was well below yesterday's close. So if you're a big candle aficionado, I don't think that really classifies as one of those key reversal candles you might be looking for to validate the distribution that you saw today. Just to wrap up very quickly, I wanted to look at breadth for a moment, only because I think it was a pretty good distribution day. I didn't look at the advancers decliners until early in the afternoon. Yeah, so by my quick reading, and again, we've not processed all the closing data yet. We sort of do that over the next hour or so, but right at the close, it looks like about 16% of the NYSE listings were up today, which means 84% of them were down. That is a pretty significant down day. That's the most that we've seen in quite some time. As you can see, looking left on the chart, how rare that this many names actually rotate lower. It shows you the strength of the distribution, not just in a narrow group of stocks. This is a lot of names. This is after yesterday when the market rallied with only 52% of stocks actually up on the day. We need to wrap this this segment. We'll take a quick break. We'll be back with Kathy Donnelly. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close as we break down the activity in the markets using the Technical Analysis Toolkit. A couple quick announcements before we get to today's guest, Kathy Donnelly. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. We'll be featuring questions from viewers like you in the last day or two. Keep them coming. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. It is totally free. Fantastic, knowledgeable guests like Kathy Donnelly and many others. Special events like The Pitch, Chart Madness, which was just a couple weeks ago. So much more, all on demand at StockChartsTV.com. Or on your mobile device, just search for Stock Charts TV on demand. I want to welcome on today's guest, Kathy Donnelly. Kathy's the co-author of The Life Cycle Trade. Did a great job joining us on the show, I think before the holidays. So Kathy, it's great to see you and welcome back.
Thank you for having me. It's great to be here.
So when I asked you what sort of things you want to look at, you actually brought a couple IPOs with you. Wanted to start with the chart of Airbnb. Obviously, a lot of IPOs in recent years have been fairly choppy, right? There's been a choppy movement to them. How are you looking at the chart of Airbnb here?
Yeah, exactly. To your point earlier about the trend of IPOs the last few months has just been down. So I wanted to share Airbnb because it's one of the ones that is somewhat constructive. It's been going sideways in this market where if you look at the most recent IPOs for the last 3-4 years and all you see is just big downtrends. But this one has been going sideways. It actually hasn't even undercut the low from that second week of trading, which is pretty amazing when you look at most of the IPOs today. And everybody keeps talking about reopening play of Airbnb, and maybe this is the year. It's back over its 40-week line, and so it's still, not the constructive base that I would like to see, but it's near a point where it could be breaking a trend. And if we can just have the market cooperate, maybe this will be one of the IPOs for this year. So this is on my watch list, and I wanted to share it with your viewers.
Your second chart, and you taught me a ton about, we were talking about this name before we started. It was getting me hungry because it's just after lunch here in the Pacific time zone. Sweetgreen, ticker SG. What about this one?
Yeah, I wanted to talk about this one because this one's a little bit younger. Airbnb's been trading about 2 years. This one's only been trading about 4 months. And for a strong institutional due diligence phase, which is what I call that sideways action that we saw on Airbnb, this one's only been going about 4 months, but it could start early. And it's also holding up compared to many IPOs that are in that huge downtrend and not going sideways. So here, it's come back a little bit and it's going sideways. So who knows? Maybe this will be one that'll jump up. It's salad. So people that are into healthy eating, there's about 150 restaurants in 13 states when I just checked my last. And so I've been there. It tastes good. So who knows? It could be the next Chipotle for salad food. You never know.
It could definitely be, and it's interesting again. So I think a lot of people have been scared away from IPOs, generally speaking, just because of the challenging environment that we've been in, and the fact that obviously a lot of them have been struggling a bit. We were talking in the market recap a little earlier, Kathy, about just the overall market conditions. We have sort of this push and pull between. I feel like growth is working, value is working on one day. This week, you get a very different feel, day to day. I mean, overall, how are you interpreting what's happening in this market now? Does this feel more like a risk-on time to be taking some opportunities to you, or is this more of a time to be, raising cash and thinking more defensively, generally speaking?
I'm definitely still thinking defensively. We didn't look at the Nasdaq. This is the S&P. The Nasdaq, is still below its 40-week line and its 200-day line. And I'm really concerned with the Nasdaq because if you look at the weekly chart of the Nasdaq, the 40-week line actually started declining as of last week. The 200-day is still going up slowly, but the 40-week line is just started declining. So we've really got to break through. And then hopefully we'll be more on a risk-on situation. But I'm still very defensive until that happens.
Yeah, and that leads me to my last question then. It would be, what would you need to see to get more constructive? Because I have to agree. I mean, I see so many just headwinds to what's going on. I see a lot of stocks heading into resistance. Apple, for example, right, sort of testing previous highs. When you're looking at a chart like the Nasdaq or even of Apple, is it getting above that certain level that would give you more conviction that there's further recovery from here? What would you need to see to get less defensive, I guess, for the markets?
Well, I definitely would like to see the Nasdaq get back above that 40-week line. And also, I'd like to see more IPOs with constructive first mature bases. That's something that we coined in the book, The Life Cycle Trade. We're in that institution due diligence phase, in that sideways action. You see a constructive first mature base that'll get it over its 40-week line and through that turbulence zone, which would be the prior's highs that it made when it first came out as an IPO. And we're just not seeing a lot of that yet. So until I see it becomes a buyer's market, then I'll feel a little bit better.
Kathy, it's great to see you. I appreciate you sharing some perspective on IPOs. I know they can be a challenging area of the market for people that are less familiar. I know your book does a great job of helping dispel some of those myths and helping people get more comfortable with it. Listen, great to see you. Stay well, be well, and we'll talk to you again soon.
Thank you so much.
That's Kathy Donnelly. Kathy's a co-author of The Life Cycle Trade, hitting on a couple IPOs, but I got her to talk a little bit about sort of this overall environment. I'm hoping to ask every guest that comes through just some general sense of risk on versus risk off and what you need to see. I thought her comments there at the end were fantastic about just looking for some sort of movement above key moving averages. I feel like with all this rally that we've seen in some of those, in the Nasdaq, some of the growth areas in the market, we're still not eclipsing sort of some basic measures of an uptrend, right? Is the stock or the index above its 40-week or its 200-day moving average? Once it does that, it's going to get harder and harder to be defensive. But great take there from Kathy Donnelly. Let's continue on with our next segment. The Final Bar Mailbag. As a reminder, all of our questions come from you, our viewers. These are from the last couple days. Please keep them coming, and we'll do our best to get to them on the show. Here's question number one. So as 2s and 10s potentially invert or kiss the zero line last week, Tony Dwyer came out with a 3-month to 30-year look and threw some shade on the 2s to 10s inversion. I noticed you pivoted to 3-month to 10-year as well and said that this time it's potentially different because the 3-month versus 10-year comparison is headed in the opposite direction. Can you elaborate? And I should add that is one question of a number that we received on the 10s and 2s or 2s versus 10s And so I'm summarizing it in that question. I had another question that was really thoughtful about, why people use the twos and 10 years so much. So here's the answer, right? The way that you look at these spreads on stock charts, by the way, is you can take any two symbols and just use the minus sign or the hyphen between the two, and it'll give you the spread between the two. This is a great way, particularly when you're comparing interest rates or something that's quoted on a percentage basis. It's an easy way to just look at the two. And a lot of in the bond markets, you do a lot of spreads between different interest rates and comparing different curves. So here we're actually looking at the shape of the yield curve. So you can either use something like the fantastically designed and simple but powerful historical yield curve, dynamic yield curve, which I'm blanking on. Where is it? Here we go. Dynamic yield curve. There it is at the top. This actually shows you the entire curve, and in a normal environment, you can see this general idea where the shorter end of the curve, the shorter duration, is much lower than the longer end of the curve, or the longer dated bonds. All these are all the active Treasury bonds that we're tracking there. So instead of looking at that one curve, which we allow you to do with our dynamic yield curve function, you actually a lot of ways, a lot of investors, to save time, just look at the spread between the 10-year point and the 2-year point. The reason why we tend to focus on those is because they're the most commonly used areas of the market, right? So the most commonly used parts of that curve are the 10-year point and the 2-year point. So very liquid, very commonly accessed by investors, and so it makes sense to use a fairly liquid part of that market. Here's the thing, this is that spread, and when we talk about the yield curve flattening, we talk about the spread between 10s and 2s getting lower and lower, and just in the last couple days, it's actually gone negative, or what we call an inverted curve, where the shorter end is lower than is higher than the longer end. Now, if you look at that same curve, but instead of using the 2-year point, use the 3-month point, so it's $UST3M, the curve looks like this, and it's actually steepening. So what's going on? Well, if we actually look at the dynamic yield curve, you can see what's happening. The very, very short end, this 3-month point, is really super low, and the rest of the curve is actually fairly flat, right? Fairly stable. So it's sort of artificially low. A lot of people have talked about this is the Fed and the nature of how they are rolling things out. Essentially, the market is pricing in higher interest rates, but the Fed really hasn't raised things yet. So eventually they raise them more, and the yield curve looks a little more normal to what it probably should in a sort of quote unquote normal environment. So why do we use 10s and 2s? Because that's what's most commonly used because they're the most frequently used durations. Why is that important? Well, here is a historical chart going back to the early 1980s, going back to the 1982 market low. And I'm showing that 10s versus 2s spread here. You can see every time it goes negative, goes inverted by the time it goes below the zero line. And you can see soon after, we have these shaded areas, which are US recessionary periods. So the yield curve getting inverted, particularly this 10s versus 2s point, often is a great indicator that a recession is coming down the road. And usually 6 months or so, if not a little bit further down, you have an increased likelihood of a recessionary period. You can see going back to the 1980s, every time we've had a recession, the yield curve has been inverted soon before that. So now it is a debate in the industry, and guys like Tony Dwyer know much more about bonds and interest rates in the Fed than I will ever know. So I would certainly yield to their expertise, pun intended. But the fact that this 2s versus 10s has gone negative happens before every other recession going back for decades, and that's why it's something that people follow so closely. Next question, do you prefer SPY, TLT, or GLD over the next 3 months? Great question. Which would I prefer? So the spiders we kind of know because we bring them up many times. The challenges that I see for stocks is the fact that I think interest rates are not in a great position for a lot of the growthy stuff that has been the offense for the markets, and I think that could be a challenge. There is no way that I would say that the bonds are a great option here, only because I think rates are going higher, and if rates are going higher, the bond mutual funds, the TLT, the AG are probably going to underperform pretty consistently, which leaves me with gold, which I would say easily would be my vote. I think the timing of this is going to be the biggest challenge. I'm fairly confident the TLT would not be the best performer, although it could. I mean, any of these could win over the next 3 months. It would be between stocks and gold, and I would go with gold only because I think we're going to be in a defensive posturing for a little while. Again, the timing of that over the course of the year is what's going to be the most challenging thing to navigate, but I would probably opt for gold. I'd be curious, those of you that are watching, which of the three you would pick. So let us know if you're watching this on demand. Let us know in the comments because I'd be interested to get your take as well. Next question. I've noticed on 4422 a potential pennant or triangle formation on Chevron, ticker CVX. What could we potentially expect should the pennant break out? At what price level? At what volume conditions? And finally, what would negate the breakout? So everything, tell me what's going on here. So let me zoom into about last year, which is going to give us a little more clarity into that. And the pattern you're talking about, I would probably classify as a pennant pattern. And a pennant pattern is when on a much shorter time frame, you basically have a big run higher on a stock, and then you have on a much shorter time frame this consolidation pattern of lower highs and higher lows. So it's literally consolidating around the point. So it does look like a triangle. If this is a much longer time frame, I'd call it a symmetrical triangle pattern. But when it's a much shorter time frame relative to the run that you've seen higher, you actually need to call it a pennant pattern. Long story short, here's what's happened. More often than not, a pennant pattern is considered a continuation pattern, meaning more often than not, this happens as a pause before the next leg higher. And the general way of measuring these is you measure the flagpole or the trend going into the pattern, and you project that from the breakout level. So however long we went going into there, that's your minimum objective if and when we break higher. So it's generally thought of as a continuation pattern, meaning more likely than not, this would resolve higher. And this is a pause, a consolidation before the next move to the upside. Now, having said that, the way you actually trade these or the way you follow them is to see which way the price breaks. We're getting to the natural end called the apex of this pennant pattern here very quickly because the highs and lows will come together at a singular point. So one of these things has to happen. Either we break above the trend line to the upside, or we break below trend line support to the downside. Whichever way we break, I would expect that to be the next leg in price behavior. So you're waiting to see which trend actually breaks, and you're following the direction of momentum. Now, you brought up a number of other questions. We don't have time to go through a lot of the other nuances of your questions, but I would say in terms of prices, I would look to see which way this violates. And what a lot of people also do is wait for confirmation of breaking that last swing high. So breaking below 160 or above 170 would sort of further validate the resolution of that pennant pattern. Volume is an interesting one, and if you're doing traditional analysis of patterns, you would in general expect a lighter volume through the pattern and then strong volume on the breakout. That's what John Murphy, Edwards and McGee, all of those traditional books looking at price versus volume would tell you. So that would be the way I would interpret volume over that pattern as well. Thank you guys so much for those very, very thoughtful questions. Really appreciate it. We need to wrap the show. Go to the 3 in 3. 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P 500 breadth. I didn't get to talk too much about breadth because we're going through some of the other charts today, but I think it's worth noting the S&P attempting to get above 4,600 on a closing basis, doing it for a day or two, but then coming right back down. So I would call that, at this point, a failed breakout above 4,600. I'm also noticing all these cumulative advanced decline lines really broke above their highs from February, but none of them followed through. Pretty much all of these, the next day or two, went right back below that resistance level. So until these advanced decline lines can get above their February swing highs, I would say this is a questionable breakout in terms of the likelihood of continuing further from here. These get above there, and I think you could think a much stronger likelihood of further upside potential. Again, the weaker breadth this week has been really interesting. Limited upside breadth yesterday, a lot of downside breadth today. Feels heavier than lighter. Chart number 2 is looking at 10-year yields. We talked about the yield curve. Had a number of great questions about looking at 2s versus 10s, 3-month versus 10-year, and so much more. You know, a lot of times you can simplify and just look at interest rates. Look at the 10-year point. $TNX is the index we use to track that yield. And you can see that yields have been going higher fairly consistently. Now, there was this period in much of 2021 where yields were relatively stable, if not down a little bit. We now rotated to the upside, broke above 170, and really haven't looked back. We've continued to push higher and higher. In the last couple weeks, you see rates going higher now on today's jump, but value stocks have really not been outperforming growth. It's really been mega cap growth that's been leading this market. So there's a bit of a disagreement between interest rates going higher and value stocks not participating. If rates go higher, I would assume that is the chart to follow, and I would expect that ratio to push further to the upside. Finally, where are there opportunities? This is a public service announcement that in all times, in all markets, there's usually something working pretty well. There are usually stocks breaking out to the upside and breaking down to the downside. It's all a question of following those. We're looking at a chart of ZBH, Zimmer Biomet Holdings, which is a medical equipment name. I like this chart for two reasons. Number one, breaking above trendline resistance is usually a good thing. You can see we break above the trend line, testing it from above, starting to rotate higher, making higher highs, sort of this rotation. Consider this a big head and shoulders bottoming pattern, breaking out with some daylight above. Folks, that is our show and a wrap for this show. Thanks to Kathy Donnelly joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.